Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Happy as always to have you with us, where we're going to cover some of the topics. One really groundbreaking, at least data set, in terms of market implications. And it may not be what you think it is, but we're going to talk about a Tame Inflation report. We're going to talk about moving away and really some data impacts from the moving transitions in a post-COVID world. And then Andrew's going to cover in depth the sector leadership. Anytime we see big moves in the market, that's something he takes a deep dive into. And so he'll share that with you. So moving now to what we call here Tame Inflation, which may be an ironic title because 6.3% on a core inflation rate doesn't seem tame at all. It's simply tame relative to where we had been. You can see this is a chart of that core inflation, and we do strip out the energy and food components of those simply because that's a main characteristic that the Fed looks at in terms of forecasting and sticking in with a trend. And so what we've seen is it spike up to over 6%, but this is the first time here that we saw a big size down to 6.3%. Perhaps more important, what that number was 0.3% on a month-over-month basis, which means if we were to have an inflation rate at the same level that we had on the month of October for the next 12 months, that would trick down to 3.7%. So the significance of that is it really changes or has the potential to change the narrative of the Federal Reserve and the degree to which they will ultimately raise interest rates. So that's the good news that the market took away with gigantic moves in both stocks and bonds. Not to be negative Nellies on this, but we have to characterize this in balance with a couple of key points. And the first is that it is 1 month. And so just like we would expect none of you, we wouldn't expect the Federal Reserve to make too much out of one report. They will get the next inflation report before they meet and make a decision on interest rates. So you can bet that at that point in time, that data release will be very heavily watched, because if you got 2 months like that, now you have the ability for the Fed to change some of their language, and the market clearly began to move in the direction of very hopeful that that will continue. So we will have all eyes on that one. I'd say when we look at really in depth at the bond market, it did not reposition itself in such a way that forecasted the Fed changing its strategy. So that's one thing that we have at the back of our mind in terms of getting too overly optimistic just yet with that move. Instead, we're going to be looking for the market to build technical moves and see if it can break out and have price action that goes into a positive trend. And hopefully that will continue. Moving next, we're going to look at housing relocation data. So this is just fascinating to me because we are looking at median data across the entire nation. So what this is looking at is the distance between a home that was sold and where the new residence was purchased. So this has been a pretty stable relationship. Most people are buying near where they used to live. They're moving from one neighborhood to another. They're not moving further away. And that median move has been about 15 miles. So very clearly staying within the same school district, just to put it simple. But that has jumped up to 50 miles. So this post-COVID work from home hybrid environment that we live in has seen a true migration. In fact, we saw the highest share of those homes being purchased in rural areas going all the way back to 2003. So truly a different trend, and maybe that will stick. There is expected to be a pretty hard battle between some employers who are trying to end the work from home, or at least an aggressive work from home strategy, and some are embracing it as a way to cost and save money on occupancy costs. So the battle of that win will largely determine the degree to which this move could continue. So, Andrew, we're going to shift to you now and look at sector leadership and what you have seen in that big size to make move last week.
Yeah, thanks, Adam. So one of the questions we often get asked every time the market starts to move higher is, was that the low? Was that the low? Are we finally done? Is the pain over? And so what we're going to share as much as we can on these weekly calls with some of the different things we look at, some of the different pieces of data that should suggest when we started moving from a bearish regime, a bearish trend, into a bullish trend. And one of those is what type of sectors are providing leadership. And so the first chart we're going to look at is actually going back to 2008 and 2009. This was during the financial crisis, and we have all the different sectors of the market split between these two charts. First, we're looking on the far left. Here's how the market, all the sectors were performing from October 2008 to the final low that happened in March of 2009. The worst performing sectors were financials, industrials, materials. And then we saw once the market finally bottomed in March of 09 and they started moving higher, that takes us to the chart on the right. And that shows us what sectors were performing the strongest. Well, in fact, it was actually the worst performers on the way down. The best performing sectors on the way up were, again, financials, industrials, materials, and consumer discretionary, XLY. And so we can see that whatever the sectors that took us that led on the way down are very rarely the sectors that lead on the way up. In fact, we often see just the opposite, that whatever was the weakest on the way down gets to be a little bit oversold, and the buyers that come back into the market start trying to bid higher, trying to find value in some of those beaten down sectors, and they end up being, at least temporarily, the new leaders on the way up. We saw the same thing, we discussed this on our Monday call back during the tech wreck, and where the sectors that led on the way down were not the ones that led on the way up. So when we start looking for signs that we're in a new bullish trend, we want to say, is the sectors, have they rotated leadership? And so now fast forwarding to today, let's take a look at our current sector performance. So this chart, again, looking at our current year, on the far left, we have all the sectors performance from January through October. And we can see, as we've said many times in this call, energy has really been the strongest sector. And along with consumer staples, healthcare, and utilities have been the best performers. So how have they performed since the most recent lows in October? It's been about a month now, so we have a little bit of data to go off of, but we still have energy leading, materials, industrials, financials. A lot of the sectors that still were outperforming on the way down are still showing leadership characteristics since the bottom in October. Now, we still have plenty of time where we could see that rotation that we traditionally see at the start of a new bull market, but as of right now, we're just not seeing that yet. The fact that we're still seeing the same leaders on the way down over the last month tells us that we haven't seen that rotation that typically takes place. Now, again, we always want to keep an open mind, and we don't absolutely have to see sector rotation, but that is a common characteristic of a shift from a downtrend into an uptrend for equities. We see that change in leadership for the sectors. And so that's something we're going to be looking at as we move into the year end. Do we see that development take place? Do we see new sector leadership take over? And that would be a great sign that that low in October was a durable low and we could continue to move higher. At this point, not seeing it yet. Hopefully we do before year end. And we're, as always, we'll continue to closely monitor that data and discuss this on every week in our call and bring the most important topics to you in these weekly market carvers.
Oh, excellent work, sir. Appreciate all of you for giving us a few minutes of your time. We do have to mention that, believe it or not, next week, from the time that you're watching this, will be Thanksgiving. And so we really hope that you have a wonderful time with your friends and family. And then we'll be looking forward to sharing more insight with you after that holiday break. So thank you again. Have a most wonderful weekend and happy Thanksgiving.